We have Geoff Dennis, who is the independent emerging markets commentator, joining us on the show. Very good morning to you, Geoff. Thank you so much for joining us on ET Now this morning. Trying to understand or gauge what should one be prepared for in the year 2025, because given the fact that you had the Federal Reserve go ahead and lower their dot plot, when you talk about the rate cuts for the come next year, you saw the market spook. How should one read into all of these signs? Because yesterday when you saw the US GDP growth as well, they revised it upwards.
Yes, I think it's a difficult environment for emerging markets. Let me start by saying that, and I think it's summed up by the fact that the Fed is now assumed anyway in terms of the dot plot that the midpoint is 2 interest rate cuts. I think what the Fed is doing here is they are accepting that the challenge, the benefits, if you like, of sharply lower interest rates next year are basically not there anymore, and they're therefore being more cautious. There are three things going on. First of all, as you just mentioned, the economy is reasonably strong. There doesn't seem to be a recession on the horizon. Secondly, inflation has seemingly bottomed out between 2.5% and 3% headline, 3 to 3.5% core. And of course, we have the enormous uncertainty of what will happen to tariffs and to to the tax situation when President Trump comes in. And I think for the first time, Chair Powell kind of tipped his hat to that, saying we just don't know what's going to go on. So I think in this environment with not much in the way of rate cuts, I thought there'd only be two actually in the new dot plot. I thought they would be a bit more hawkish. I'm surprised the market was so surprised, but there you go. But I think a market here where the dollar's strong and bond yields are rising, which makes it very hard for countries across EM to cut rates. I think this is just a very tough environment. And so I don't think investors should be all that constructive going into 2025.
Well, Geoff, sounding an alarm bell there, but that's exactly what's happened with China too, right? They've managed to hold their loan prime lending rates, and let's talk about Japan as well. The inflation has peaked to a 3-month high there.
Yes, I mean, I think with China, the story, quite frankly, is that we need to see the fiscal action. And unfortunately, in business and in the world, you're supposed to under-promise and over-deliver. Well, what the Chinese are doing on fiscal policy is over-promising and under-delivering. And the market is not impressed, and they're waiting for decent fiscal action. So I think minor tweaks to interest rates just won't make any difference in China right now. And this is why people have turned a bit more cautious again. On Japan, I think all it's doing is making, I think, further rate hikes or perhaps I should say slightly tighter monetary policy going forward, being more likely than the most recent data that you've seen, as you mentioned. But they're going very, very slowly, and this is, of course, getting reflected in the weaker yen, which in turn reflects the very, very strong dollar. So I think Japan is not being very helpful here, and the Chinese were waiting for something that's really going to be decent enough to support the Chinese economy significantly, particularly the consumer and the property sector. And frankly, it's been a long wait.
All right, Geoff, but given the uncertain environment in the equities right now, yes, they did have their ups and downs, but the gold did shine in the whole year of 2024. So going ahead in 2025, do you believe that this asset class is ready to shine even more, and the money could be flowing in here?
I don't follow gold particularly closely myself, but these are pretty ideal conditions, I think, for investing in gold. First of all, inflation has come down, but it's still a little troublesome, and therefore investors will probably see gold as an inflation hedge, just in case inflation happens to tick back up again in the US and in other countries. As we all know on this program, the geopolitical tensions around the world are numerous, and we then have to deal with incoming President Trump in the US, who could introduce major changes in policy towards all sorts of countries, the Ukraine, the Israel-Gaza story, Iran as well. So I think gold as a safe haven will still be well bid. Now, I'm sure it won't do as well as it's done this year, but I would not think this is a selling opportunity here. especially given what I think is a very poor outlook for US bonds. I mean, I think US bond yields are going to go to 5%, 10-year yields. They're heading that way now. It'll take a while, maybe a little higher than that. And in this environment, investors, I think, will be looking for safe havens, and gold will be one of those, I think.
All right, then we leave it there. Thank you so much, Geoff, for joining us on the show to talk about the emerging markets, the entire global scenario, and how that bodes for all of us back home as well. Thank you so much, as always, for being part of the show.